Welcome to the deep dive. Today, we're tackling SoFi technologies. SoFi. Their whole pitch is helping you get your money right.
hmm
But our mission today is a bit different, figuring out if SoFi's business is getting its money right.
Exactly. And we're going straight to the source material, their Q2 2025 financials, the 10Q, the earnings release.
Right.
This is all about the fundamentals. We'll break down the growth, look at the financial health, see what management's saying, basically giving you the numbers and context you need to weigh that buy or sell argument for yourself.
Okay, let's jump right in. Top line results. If you were hoping for growth, well, SoFi delivered. Total net revenue for Q2 2025, $854.9 million. That's 43% higher than last year.
Yeah, a really strong number. And maybe even more importantly, they hit a major profitability milestone. We're talking GAAP net income, the standard measure.
Okay.
That came in at $97.3 million for the quarter, which is, well, it's a huge leap from just $17.4 million a year before. They've actually done it. Moved from just growth to profitable growth.
That's a massive shift. And per share, what does that look like?
That translates to diluted earnings per share, or EPS, of 0 JET or 8 cents, up from just a penny, 0 words and 1 cent last year. So real bottom line improvement.
But management often points to non-GAAP numbers too, right? To show the operational side.
They definitely do. And those numbers look even stronger, frankly. Adjusted EBITDA, which takes out things like stock compensation and acquisition costs, that hit $249.1 million.
Wow.
Compare that to about $138 million a year ago. It's almost double. And management uses this to highlight what they call the Financial Services Productivity Loop, the FSPL.
Ah, yes, the FSTL. Getting members to use more SoFi products, creating that cycle, does it seem to be working? What are the member numbers telling us?
Well, the engagement looks really good. Total members climbed to 11.7 million. That's up 34% year over year.
Okay, solid growth.
And what's interesting is management sounds quite confident. They're forecasting adding at least 3 million new members this year in 2025. That keeps the growth rate around 30%. So, yeah, the ecosystem is definitely scaling up fast.
All right, so big picture growth is there, but SoFi isn't just one thing, right? It's got lending, the technology platform, financial services. Where's that 43% revenue growth actually coming from? Which part is pulling the weight?
That's the key question. And when you break it down, it looks like a bit of a two-speed company right now. The real acceleration, it's overwhelmingly coming from one place, the financial services segment.
Okay, let's call that the engine then. Financial services revenue up 106% year over year. That's huge. $362.5 million.
It is huge. But check out the profit figure for that segment. Contribution profit. It was up 241%.
241%.
Yeah. Hit $188.2 million. Just explosive profitability growth there.
How on earth did they manage that? What's driving that kind of jump?
This really gets to the heart of their strategic shifts this quarter. It's something called the loan platform business, or LPB.
LPB, okay.
Basically, they're generating fee income. They originate loans for other companies, or they refer pre-qualified borrowers. It's a fee-based model. Doesn't require much capital.
So less risk on their balance sheet.
Exactly. And the non-interest income from this LPB, it went from $12 million last year to over $127 million this quarter.
Wait, say that again?
12 million to 127 million. That's a 960% increase.
960%. Okay, hold on. So they're making massive fee income selling or referring loans. Does that mean they're maybe worried about the quality of loans they're originating? Or are their own lending margins maybe getting squeezed?
That's a really sharp question. I think it's less about worry and more about a smart strategic pivot. They seem to be realizing, hey, our underwriting is good. We have all this member data.
Right.
We can make money off that expertise without holding all the credit risk ourselves. They're essentially becoming a supplier of well-underwritten loans or leads.
Okay, so monetizing the platform differently.
Precisely. This LPB growth proves they can generate really high margin revenue that isn't tied directly to interest rates or capital requirements in the same way traditional lending is. It really changes how you might value the whole platform.
And the product adoption numbers seem to back that up too. Total financial services products, almost 15 million now, up 35%. Lots of SoFi Money accounts, Invest accounts.
It's got 5.9 million SoFi Money, nearly 2.9 million Invest. The ecosystem is definitely getting stickier. And don't forget those deposits, the bank charter advantage. They're sitting on $29.5 billion in deposits now.
Which means cheaper funding.
Exactly. Cheap, stable funding. That's a significant competitive advantage. So, okay, financial services is the accelerator. What about lending, the traditional core?
Right, the stabilizer, perhaps.
Good way to put it. Lending is still the biggest chunk of revenue, $443.5 million in Q2. That's up a respectable 30% year over year, mostly driven by personal loans.
And that lending activity still drives net interest income, NII, right?
Absolutely. NII for the whole company climbed 26% in the quarter.
Yeah.
And that comes from, well, two things mainly. Originating more loans overall, and now that they have those stable deposits, they're holding some loans on their books for longer.
Got it. Okay, so FS accelerating, lending stabilizing. That leaves the technology platform, Galileo and Technisys. This was supposed to be a big differentiator, but the numbers, they look a bit sluggish.
We do, yeah. Tech platform revenue was $109.8 million, up 15%, which sounds okay. But contribution profit only grew 7% to $33.2 million. And the metric they use for scale total enabled client accounts, it only nudged up 1% year over year to 160 million. Barely grew.
They did flag some new client wins, though, didn't they? Like Banco Nacion.
They did, yeah. And Wyndham Hotels for a rewards debit program, so they're still signing deals. But the overall growth rate in that segment, it's clearly slowed down.
Okay.
And this leads to something pretty important, Bertie, in the financial notes. Yeah. It's about goodwill. Remember, they pay a lot for Galileo and Technisys.
Right, acquisitions, big price tags.
Well, those units carry over $1.3 billion in goodwill on the balance sheet. Management had to assess the fair value, and their conclusion was that the value is, and this is a key phrase, not substantially in excess of the carrying amount.
Not substantially in excess. Okay. Translate that from accounting speak. That sounds not great.
It's subtle, but it's basically a warning sign. It means the tech segment is, like, barely justifying the amount SoFi paid for it based on current performance and future expectations. If things slow down more or the market shifts,
they might have to write it down.
Exactly. An impairment charge, which is Wall Street code for we overpaid. It signals real pressure on the growth outlook for that part of the business.
Wow, okay. That's a stark contrast to what we're seeing on the credit side, though. Let's pivot to that balance sheet health risk. How are their loans actually performing?
Surprisingly well, actually. Credit quality strengthened in Q2, which is pretty impressive given, the wider economy.
Strengthened? How so?
Well, take personal loans. The 90-day delinquency rate actually went down from 46 basis points to 42 basis points.
Okay, that's good. What about charge-offs? Actual losses?
Office improved. The annualized net charge-off rate, NCOs, for personal loans dropped to 2.83%. That's down from 3.84% a year ago.
Nice improvement.
And for credit cards, it was a massive improvement. The NCO rate was almost cut in half, dropped from over 16% down to 7.7%.
16% down to 7.7%, that's huge. Suggests their underwriting is holding up really well.
It really does. Seems the loans they are keeping are performing strongly.
Okay, strong credit. What about liquidity, capital? You mentioned the deposits, but do they have enough funding capacity?
They seem well positioned. They have about $7.3 billion available in warehouse facilities for loans, and they've only used about $2.1 billion. So plenty of capacity there.
Dry powder.
And another key metric for a bank, tangible book value, TBV per share. It was $4.72 at the end of June. And management is actually projecting TBV will grow by about $640 million for the full year 2025.
Which means they're building their capital base.
Right. Building that buffer to support growth and absorb potential future risks. It's a very positive sign for fundamental health.
So the core financials look solid, credit's good, capital's building. Are there any, big regulatory things happening that could help or hurt them?
There's actually a potentially significant tailwind coming from Washington. Something called the One Big Beautiful Bill Act, or OBBB, signed in July.
OBBB Act. Okay, what does it do?
Starting in July 2026, it gets rid of federal grad PLUS loans entirely. And it puts new restrictions on parent PLUS loans.
So it limits federal student loan options?
Exactly, for graduate students and parents, which basically clears the field in those areas. It's going to be a huge opportunity for SoFi's private student loan business, both in-school lending and refinancing. It's like the government is reducing their competition.
Interesting. A regulatory gift, almost. But there are always risks, right? Interest rates must still be a concern.
Oh, absolutely. Interest rate risk is always there for a company like this, with loans and deposits. They have variable rate stuff on both sides of the balance sheet.
So they have to manage that carefully.
Yes. They use derivatives, interest rate swaps, caps to hedge that risk and try to protect their interest margins from big swings. It's a constant balancing act.
And one more risk area, they're talking about crypto and blockchain integration. That sounds potentially tricky.
It is. They're definitely moving into that space, but they acknowledge it's complex. Regulations are changing constantly all over the world.
Right.
Plus, you have the price volatility of crypto itself, operational risks like getting hacked, and the very real chance of facing regulatory action or big losses if they mess up on compliance or security. It's definitely high risk, high reward territory.
Okay, let's try to wrap this up. Summarizing the internal picture from Q2, it really looks like a company successfully shifting its strategy. Strong overall growth, they hit GAAP profitability,
Hmm.
mostly powered by that incredible acceleration in financial services, especially that capital light LPB business.
That's right. And the core health looks solid. Credit is performing well. Capital is building. That TVV growth is key. But you absolutely cannot ignore the pressure on the technology platform segment. That goodwill warning is significant.
Yeah, suggesting the value of that tech infrastructure might not be what they hoped.
It's definitely under pressure.
So, bringing it back to the listener, maybe thinking about SoFi as an investment, what's the final takeaway here?
I think the fundamental question for you as you analyze this is really about that internal race. You've got this powerful capital light profit engine in the financial services segment throwing off cash.
Right, the LPB effect.
Can that engine generate enough profit fast enough to essentially overcome the growth challenges and, frankly, the valuation risks we're seeing in the technology segment? It's the accelerator versus the potential anchor.
Okay.
Is that explosive FS growth and the solid TBV build enough to justify the whole platform's value, especially with ongoing rate risk and the uncertainties around their crypto ambitions? That's the core tension you need to evaluate.
A really interesting strategic race playing out inside the company. Okay, that's all the time we have for this deep dive. Hopefully, breaking down these Q2 numbers gives you a clearer picture of SoFi's fundamentals.